Hey, welcome back. It's Jason Walter here. In today's video, I have a special guest, and that's Jim Black of All Cal Financial based in Santa Cruz County. Welcome to the channel.
Thanks, Jason. I appreciate you having me on.
Yeah, absolutely. So Jim and I have known each other for a very long time, probably since middle school, I'm
I think,
guessing.
yeah, it's been a pretty short time. I think since seventh grade. Yeah.
So for a couple of years now. So yeah, this is really great to have a buddy on the channel who is an expert in your field. You have been a loan officer for 19 years, and you've helped 7,500 families with their home ownership needs, which is pretty awesome.
Yeah, it's exciting. Every day is a new challenge, and if you have a passion for this, it's pretty easy because you help people with their dreams of home ownership. So
Yeah,
I love
absolutely.
what I do.
That's awesome. Yeah, well, Jim, thanks for taking our time today. I know a lot of people are getting a lot of value because I had a lot of people ask me questions about, what's going on with the mortgage industry right now, or do we have a tightening of protocols right now for credit worthiness? And how does now compare to pre-COVID and also compared to 2008? And a lot of homebuyer questions. And so I think let's just basically dive right in. And let me, I guess, first give us a background about you and your company, All Cal Financial, and then we can give us a little bit of a mortgage update if you could.
Sure, absolutely. So I've been doing this now for 19 years. I love what I do. There are two channels in mortgages. There are retail banks and there are mortgage brokers or privately held companies. I was in the retail channel for about 14 years and decided that it was time to create a better system, a better process, better pricing, and build a company the way I thought it should be built. So I created All Cal Financial. We're licensed in California, and I have over 57 different investors to help make good choices for our consumers. And what's nice about that is what we do is we are regulated by the mortgage industry. Retail banks are regulated by FDIC, SEC, SIPC, all the different types of authoritative regulators, and it makes it more challenging for retail companies or retail banks to do customized solutions, which are the most important thing. So I love the customization of what I do, and that's why I started All Cal Financial. We have about 20 employees, and we do loans throughout California. So if it's a purchase, a refinance, a bridge loan, a home equity loan, or even other types of loans, reverse mortgages, we love helping customers. So thanks again for having me on.
Yeah, absolutely. I mean, you're the guy when it comes to mortgage questions. We definitely I've utilized your services in the past. Just refinanced about a year and a half ago and 2.625. So yeah, definitely appreciate all your insight you provide. And let's go ahead and dive into some questions here. First of all, could you give us a mortgage update? What are we seeing in your industry? What's going on?
Sure, absolutely. So it's August 2nd today, 2021. So today's stuff is based on what we're seeing today. In the last 30 days, we've seen a decrease in rates of about 0.375%, which is 0.375. That difference in rate change allows buyers to have more buying power to buy a home. Every 0.5% difference in rate change, better or worse, creates more buying power or less buying power by about 6%. So for simple terms, if you're buying a $100,000 home, I don't know where that exists, but that would be a difference of $6,000 of buying power if the rates moved. Today's rates are hovering right around 2.75% with an APR of about 2.8. And that rate is a fantastic rate right now for the long run. What's most important when we look at rates, though, it's great to look at long-term fixed programs if your goal are long-term. A lot of banks make the mistake of just offering one solution. For me, as a mortgage broker, I'm always going to look at the best customized solution for my clients. So for example, today's rates of around 2.75 are fantastic if you're holding the loan for the long run.
Yeah.
If you're selling in 3 or 4 years from now, a 30-year fix might not be the best solution because your goals might not be long-term. So we're always trying to meet the objectives of the client. So the first question I ask is, what are your goals? And when I do that, we can create a really good roadmap and custom solution for their needs, which is the number one thing that's important about what we do.
Yeah, absolutely. I agree with that. And so out of the loans you're working with, is the vast majority of the ones you're doing for, I guess, purchases, would those be like 30-year fixed rate mortgage that you're seeing?
We're seeing a lot of people get 30-year fixed mortgages because they're either first-time home buyers or move-up buyers that are getting through a life event, and their next life event is probably 10 years or longer. So we are trying to position everyone for the peace of mind of having that long-term fixed. The lowest rates we saw on a 30-year fixed were about 2.375, and the lowest rates on a 15-year fixed were 1.75. So pretty amazing to look back. If you look back the last 30 or 40 years, we're definitely at the lower scale of things. And again, rates change every day, but it's pretty amazing to think about how lucky we are to have low costs of borrowing money, which allows us to feel more confident and comfortable that we're going to be able to afford what we're doing today for the long run.
Yeah, absolutely. I think when my folks bought their house in Sacramento in the 80s, I think their interest rate was around 15%. Now we're talking about rates of around 3% for, gosh, over a year now, which is absolutely nuts. And of course, that's one of the main drivers of why home prices have skyrocketed so much. Kind of like a tangent, I have a question for you. For interest rates, obviously, we're less than 3%. Let's just say around 3% right now. So as a owner of a mortgage company, where do you see rates headed for the rest of the year into 2022? Do you think we're going to be increasing above 3%, approaching 4%? Any thoughts regarding that?
Absolutely. So I was fortunate to study economics in college and then in grad school. And I do believe there's a very large core inflationary pressure happening. That pressure is unique because of COVID. So certain industries that probably weren't as big of a focus before COVID have now become accelerators of inflation. What that means is if I can buy a pen today for $1, tomorrow I could probably buy the same pen for $1.25, just as an example. So as inflation kicks in, that is the biggest fear for the government, because what it does for people that are on fixed income or retired families, it pushes them out of being able to afford to live. And that's the biggest concern is inflation. And so what we do to counteract that inflation is we raise interest rates to have people save more than they spend. When you do that, it takes out some of that demand for more product, because demand is what's pushing up pricing.
Right.
So with I believe what we're going to see with rates in the next 6 months to a year, we will probably see about 0.5% increase in rates because of that core inflation number. Again, we have to think about the United States economy, but also the globalization of the rest of the economies. So a lot of times people just think about the US versus the overall effect that it has everywhere. So sometimes we'll do things not based on the US economy, but on the global effects for being able to have imports or exports or jobs or manufacturing. So I believe we'll see rates go higher. And I do think it is a fantastic time to reevaluate your refinance goals, taking out cash out for home improvements, or when you buy a house, truly looking at your long-term needs. And I think it's important to look at, when you look at buying a home, make sure that you get the right rate for you. And that's called buying down the rate or possibly paying points if it makes sense to do that.
Okay, let's talk about that. So I had a viewer actually had a question, and this is from Eduardo Blandon. So how does buying down interest points work? And how can I determine whether it's better for me to put the money towards the down payment or lowering the interest rate? So that's, I think, a really good segue to his question. So you have an answer for him regarding that?
Absolutely. I'd love for you to share my screen, and I'd be happy to talk a little bit about it more in numbers and cents. And I can just let me know when the screen's up and I'll share it with you.
All right, there you go.
Okay. So you should see, this is MBS Highway. I'm a subscriber, and this is a great tool that I use a lot. This talks about the opportunity cost of buying the rate down or not. In this example, it's a $500,000 loan amount size. I'm just using a very dramatic example for this today. If the rate today was 3.5% at no costs, and you could buy the rate down to 2.75, paying one cost or $5,000, what is the true break even or difference in savings?
Great.
If you look here, you'll see if you took the no point option over the life of the loan, you would have paid $308,000 of total interests. If you look at paying a point or $5,000, you'll have shaved off about $74,000 of the overall payments, which means the break even or months to recover the cost versus savings is 25.
Yeah, look at that. That's only 2 years in order to break even with paying down your rate. So it's really important to interject here, but really important to kind of figure out before you jump into something like this, how long will you be living in the house, or how long do you plan to own the property, right?
Absolutely. So we always want to look at this. And this is the most important factor, I think, is looking at the overall cost of, buying a home. What is the affordability? What is the payment, right? Payment is so important. You also notice here, a lot of people don't talk about APR. That's the annual percentage rate, okay? That's based on a 30-year term. So some people get so fixated on the APR, that only really is a big factor if you're going to keep the loan for all 30 years. So
could you explain to some of the viewers who may not have an understanding about what is the difference between rate, which is interest rate, versus APR? Maybe just a brief breakdown about the differences about that.
Absolutely.
Thanks, Jim.
So the rate is the actual note rate you're paying on your mortgage. So your payment on this, for example, would be based at 3.5%, and the payment will be $22.45.
Yeah.
The APR is adding in all of the costs and prepaids into an annual percentage rate over a 30-year period of time. So if I add in the costs to acquire the mortgage, that's anything from the title and escrow fees to the appraisal fee to whatever you may have, that official rate would be 3.516 over the life of the loan.
Right.
Again, the challenge is that's a 30-year time horizon. A lot of people don't keep the loan that long. But what's the most important thing to look at when you're looking at interest rates is your overall payment and the amount of savings in a break even in terms of months it takes to look at the best solution for your needs. So a lot of clients, unfortunately, just get one option from a bank versus talking to a mortgage broker who can create some unique solutions and custom solutions. So that's what I love about our industry.
Yeah, I agree. I think that acting more as an advisor, both in my role and your role as a loan officer, and mine, of course, as a real estate agent, is being more of like an advisor, listening to our clients' needs, and then basically making, advising based on what's the best thing for them based on their situation, rather than just saying, here's a 30-year fixed rate mortgage, you should refinance right now. Or for me, hey, you should buy a house right now because interest rates are so low. Who are we to say that to everyone, right? Everyone's goals are different, right? So I think it's a really important thing that you do there. So thanks for sharing that.
Yeah, we will always add value. We will always be relevant if we're being consultative, if we're giving advice and giving value. If we're an order taker, just giving one option, then yes, our value is not there. So I take a lot of pride in making sure that people have a financial planner, a CPA, an insurance person, a great real estate professional like yourself. All the tools that they need to do to make the decision for their needs. And sometimes the answer is you're not ready to buy a house, or it's not the best thing to do. And that's okay also, because if we're helping people, that's the passion that we have. It's not about a paycheck. It's about a dream coming true and helping someone fulfill that.
Yeah, I 100% agree with that. I mean, I have people that contact me all the time and say, hey, I want to buy a house, but I may want to move in 3 years. I actually just talked to a past client of mine yesterday, and she's like, yeah, I want to move potentially in 2 years, but I want to sell my house. Should I buy? And I said, you should absolutely not buy a house. Who knows what the real estate market's going to be like in 2 years? Short-term time horizons, who the heck knows? Real estate in the long term, you definitely want to have long-term time horizons. I always tell people 7 to 10 plus years of actually owning the property, because you can ride out the ebbs and flows of the real estate market.
I agree 200%. And again, your house is, number one, your shelter and a place you should enjoy living. And number two, it's an investment, in my opinion. And as long as you look at the long term for that investment, you're going to be fine. You just can't look at, your Zillow.
Day-to-day changes.
Yeah, it doesn't matter. Equity is worth nothing unless you use it or leverage it or sell to get it. So it's important to know that you're in the right position for your needs, looking at the long run. And If you're comfortable with the payment, that should be your number one position. And it's important to think about those things. So.
No, I 100% agree. So that kind of goes into my next question I have for you is, how do you select? There's so many loan officers out there, right? I mean, you can go online to Quicken or whatever. There's a ton of loan officers in any city you're basically in. So how does a home buyer decide whether they're looking to do a refinance or a home purchase? How do they decide about which loan officer they should be working with? What do you advise them to look at?
Yeah, great question. To me, the biggest thing is just who creates the most value, who provides you the most information to make a good decision for your goals. I always talk about working with people or working with an agent or partnering with the resources that a client has to make sure they make a good decision. Yeah. So the first question I would ask is making sure the person has a wealth of experience. Our barriers to entry in our industry are not very high, as you probably know.
That's one of my favorite quotes in real estate. It's the real estate exam is such a joke. It's so easy to get your license. There's a wide range of people out there because of it, sadly.
Yeah, just make sure you're working with someone who knows what they're talking about, who can perform, and who has great premier options. If you work with the best of the best, they actually get better pricing from their investors because they're performing. They're providing a very seamless process, and we're clients to the investors, and we're also clients to our clients.
Interesting.
So yeah, it's really important to know that you can work with some of the best people. And like many of our industries, working with local professionals, like in California, working with a mortgage company in California is very important because there are nuances with each county, each city. There's certain things that you need to be aware of as a realtor, right? Things like
absolutely
replacing septic lines, things of that nature that come up. So working with professionals, I like to stay in my lane and do loans in California because I'm good at that. And that's why our company is called All Cal Financial. So we actually get to work with the large banks. We get to work with the credit unions. We get to work with portfolio lenders, and they are direct lenders to the government. So what's nice about that is we have the choices available. If you don't have choice, it's a red flag. So I believe in creating choice, and that makes you feel comfortable and confident that you're part of the process of your journey to homeownership. So.
Yeah, makes perfect sense, Jim. Thanks for sharing that. All right, so another viewer has a question here. This is from Katura. She says, how much should a buyer expect to put down? I would believe she means to purchase a house. Seems to be a lot higher than it has been in the past. Credit scores seem to need to be higher than they were previously. What is an appropriate credit score that a buyer should have? Thank you. So thanks for your question there. And so, Jim, do you have an answer for us?
I'd be happy to break it down for you. So the key right now we want to think about is fundamentally credit scores are a little bit unique where it's a snapshot in time of your credit profile. So it's important to understand what credit is, and we can do another segment on this later on, but credit is only a snapshot in time. So let's say one day I have a very large balance on my credit card because I bought my wife a nice anniversary gift. Well, my credit score might be lower on that day because the utilization of my credit. So a rule of thumb for credit scores is 620 or better. That's 620 or better will allow us to have conventional financing options available. So again, you don't have to have a perfect credit score. There are other factors that go into the process of getting approval. But 620 is really the basis that you want to think about. We'd be happy to talk to you about credit if you have a unique situation. We're not credit advisors, but we'd be happy to get you to someone that could help you out. In terms of down payment, there are some 0% down payment loans, but beware with those loans because the risk is associated into the rate. So you're paying a lot more than if you would put down 5 or 10%. So
is it also true for VA loans?
VA loans are
is that an exception?
Loans. You can do 0 down on VA loans. There's a very good benefit for our military families, which I admire and respect a lot for sacrificing things for our freedom. VA loans have no loan limit now. So you can go up to a $3-4 million home as long as the veteran qualifies, putting down 0 down payment, which is remarkable. So again, it's an affordability thing. We also want to make sure we put people in something that they can sustain and keep, not just do it because they can. So
Right.
that's a big part of that. On conventional loans, there's a lot of myths out there that you have to put down 20% to avoid mortgage insurance. Well, most banks and investors are getting more savvy now to realize that the bank should be covering that cost. So now there are options up to $2 million putting down 10% with no mortgage insurance.
Interesting.
So for example, if I'm buying $1 million house, I could do a 10% down or a $100,000 down payment, and it would be the same rate as if I put down 20 or 30%. So that's a big benefit in today's marketplace.
So why would someone put, if they can do 10% down and have the same interest rate if they were putting 20% down, then why would someone put 20% down versus 10%?
Great question. That's part of our job of being consultative people. And I always have people talk to their CPA or financial planner to make sure that they've got the right advice from a professional that makes sense. And when you have that happen, having less down payment allows someone to see a vision into that property. So for example, maybe a kitchen's outdated, but they love the neighborhood. Or maybe a property would be great to have a pool with a big backyard. This allows people to have that vision and be able to see past putting all their savings into the down payment. So I love that.
That's definitely true.
It creates a lot more of a value to them to have options and tools available. And again, they can put as much down as they like, but they have an option. And I think that's important because I think sometimes people don't think through all of the differences and how we do things. So I'm very proud to be able to offer some solutions that allow people to think through their decisions.
For sure. I agree with that. I mean, I think when my wife and I bought our house, it needs a ton of work, and we realized that the neighborhood's awesome. We love our backyard. But I realized also too that we're gonna have to be putting a lot of money into the house. And so therefore when I refied and when I bought the house, I tried to get as much of a loan as I could because I want to have cash on hand in order to pay for a remodel down the road. And so to answer that question, it just depends on your real estate goals. It's basically what I think we're kind of getting out of here, right?
Yep, that's exactly right. And you can always pay down a loan if you have excess money. Sometimes you can't get money if you don't have any money, right? So it's better to play it safe and always budget for a little bit of a higher loan amount and a lower down payment to make sure that you have a cushion in case you want to do things. Or maybe there's another investment. Maybe you have college coming up for your kids, or you want to buy a new vehicle, whatever it might be. Just looking at the opportunity cost of all your financial decisions is a great thing.
Yeah, absolutely. In buying a house, refinancing, it'd be one of the biggest financial decisions you make, right? So make sure you have the appropriate advisor and are taking steps based on what your real estate goals actually are, right? So that makes sense. So with that, let's talk about refinancing. So rates right now around 3%, a little bit less than that.
Rates are pretty low. And what's exciting, a lot of people don't realize when they think about rates, they think about if they have like 2 loans, for example, they just think about, I have a great first rate mortgage and I'll leave my second alone. A lot of people don't look at the blended rate of what their actual cost of money is.
Including credit card balances if they have any,
all that
student
stuff.
loans.
It's just really important to know. So I have a little screen actually. I could share with you too, Jason, if you want to see it.
Yeah, let's do that.
Great.
So my question was going to be like, is it a good idea to refinance right now? And then, how do you decide whether or not to refi or not? That was my question. I think a lot of people would have the same question as well.
Absolutely. So let's just take a scenario right now, someone who has a first loan and a second loan, and maybe that second loan was a line of credit or something like that.
Yeah.
On this example, if you can see my screen,
yep,
I have a first loan of $250,000 at a rate of 2.5%, which is a very good rate, right? Mm-hmm. And then a borrower has a second loan, which is like a line of credit, has a variable rate loan of 5.49%. There's a lot of psychology that tells the consumer that they should not touch this first loan, right? Oh my God, I have a great first loan rate. Jim, I just want to refinance the second loan. Well, if they want to look at their total blended rate on $450,000, that rate is actually 3.829%. We don't have APR here because we're talking about their current rate, but you could add APR here if you wanted to. Total blended rate would be 3.829. So even if they could refinance at 3% on all of their money, it's a way better solution for them for the long run. So what I think is most important in refinancing is, what is your time horizon look like?
Absolutely.
If I'm selling the house in 2 years, probably not worth refinancing.
Yep.
Unless there are no costs associated with it. If I'm keeping this loan for 15 years at least, then I want to get the best rate I can and look at buying the rate down or not buying the rate down to see what that looks like in savings versus costs. So I believe it's always smart to look at rates, to see what your goals are. Your goals may have changed dramatically, and it doesn't matter if rates are higher or lower. So I think it's very important once a year at least to really look at this and say, what are my goals with having home loans? Are my goals long-term or short-term? Do I see any expenses coming on the time horizon that I should prepare for? Are there home improvements I want to do while costs are, reasonable? It's just, those are all the things that you want to think about. So it is always a good time to revisit your goals on refinancing. And
not necessarily always a good time to refinance.
Exactly. The best thing I may say is, congratulations, you're in the best solution you can have. And I'll be able to tell someone that in 3 minutes. So it's worth, let's round up to 5 minutes. It's worth their time for 5 minutes to determine if they're in the best solution for them or not. So I think
makes sense. It goes back to being an advisor and not saying that everyone should refinance or buy a house, right? So I guess you mentioned something, the no cost refinance. Can you tell us about that versus, if someone's going to buy or refinance their mortgage, are there going to be closing costs associated with that for sure? Or if they're not, then is there interest rate affected? Like, for example, if there's for a no cost refi, is the interest rate going to be higher, for example? So can you briefly kind of explain the differences between those two?
Absolutely.
Awesome.
So when you look at cost versus no cost, the simple rule of thumb is it's the rate differential. Banks are probably going to be making the same amount of money off you in the long run, no matter which option you choose. But they look at it to say, if you want a no cost loan, that rate's probably higher by about 0.375 to 0.5%. Or if you want to have costs, you can save up to 0.5%, right? So you want to look at those trade-offs there. So the lower the closing costs, the higher the rate.
Makes sense.
The higher the closing costs, the lower the rate. So we always like to provide both solutions, or at least 2 or 3 solutions to look at, so that people can look at that time horizon and say, you know what? Here's the cost of me doing this today, or here's the cost of me doing nothing. And it's just good to know those differences. So,
okay, makes sense. And so when someone's trying to figure out, hey, whether or not I should actually refinance or not, you're basically saying, hey, look at your actual financial goals. How long you be living inside the house, or how long you be owning the house, in order to determine how long it's going to take you to break even on paying those closing costs in order to make up the difference there. Is that right?
Absolutely. Yep. So again, it's just each person's specific needs. We look at them and create a solution for them.
Perfect. Okay. That sounds awesome. Perfect. All right, let's take a look at some other questions that we have here. So Michael Godwin, he says, what's the atmosphere around banking institutions right now? Is it credit tightening protocols? So he's basically asking, is credit tightening right now? Are there stricter requirements for loans? Is there a higher credit worthiness? And how is 2020 similar to the 2008 crisis?
Sure. So let me start with the 2020 to 2008 comparison.
That's an easy one. Yeah.
Yeah, that's the easy one. The difference is,
as you were a loan officer in 2008, right? What year did you get your license?
2002, I got my license.
Okay. So you've been through the Great Recession, you know all about what happened there. So you're the perfect person to answer this question.
Yeah. So the difference in 2008 and that range to 2020 is, in 2008, there were loans that did not validate or verify income or the ability to repay, which is a mind-blowing mindset.
This is so crazy, isn't that? It's just so nuts. The biggest loans you can get, and you can say, How much money do you make? Oh, I make $100,000 a month. Okay, sounds good to me. You don't need to show any proof that you actually earn that. It's
Yeah.
mind blowing.
Yeah. And then in 2020, the difference there is we've had industry change where look at all the people that work in the restaurant industry or in retail, right? So the guidelines in 2020 constrain certain parts of the industries and segments of how we qualify a borrower to get financing. But the qualifications today are actually very, very sound, and they allow us to have a lot more confidence that someone's going to have the ability to repay. When we look at the ability to repay, we look at a 3-year horizon or longer to make sure someone's going to be comfortable and keep their home, right? The worst thing we could do as an industry is jam someone into something to have them then turn around and lose everything in 3 years.
Absolutely.
So
and my question with that too is, are you seeing any differences like this year, for example? Are the lending standards becoming more strict? Are they loosening, or are they basically exactly the same?
Yeah. So on our side now, what we're seeing is there are portfolio programs and unique programs coming out that allow people to qualify in different capacities. The banks are no longer the top lenders. The top lenders are wholesale lenders. There are 3 in particular: United Wholesale Mortgage, Rocket Mortgage, and Home Point are the top 3 wholesale lenders, which means they work with companies like myself to provide a superior solution, better technology, and a quicker turn time. That velocity shifting to the wholesale market allows for more programs and custom solutions to be available. Banks aren't in the mortgage business. They're in the industry to get client cross-sell completed. Banks use the mortgage application to sell things like checking, saving, Visa cards, all the auto loans, right? That's their goal, to acquire the client to get cross-sell. My goal is to get the best custom solution for the mortgage opportunity that exists. And we don't get paid more or less. We make the same margin from the lender who pays us to show who the best lender is to work with. So that's called anti-steering. We're always making sure that we have the best solutions as a fiduciary to make sure that we give the best solution for the customer that benefits them, not our company.
Yeah, makes sense. Okay, that sounds perfect. And so you're seeing like more products available out there for people based on whatever their real estate goals are. Basically, is what you're saying.
Yep, it's a great thing for us, and I don't think we're going to see a credit dip. We're going to see people still well qualified. There may be inventory issues or supply chain issues with being able to build homes.
Yeah,
people who own homes now can afford them, which is a good thing. So.
For sure. Yeah. I mean, way different than 08. I think that what some people and what this, my subscriber here is alluding to is that maybe people worry that, credit standards are going to be loosening, and therefore there are going to be more risky loan products out there that could just implode down the road. Right. And so what you're basically saying is that that's simply not really happening right now. Is that right?
That's correct. We have full doc qualifications on all of our loans. Average credit score on our transactions is about 720. Average reserves in the bank are 9 to 14 months. Average
of your expenses. Okay. Yeah.
An average debt to income is around 30%, which means if I make $10,000 a month, my overall expenses are less than $3,000 a month. And that's the gross before tax number, which is also kind of a mindset. We can go as high as 45, in some cases 50% of my before income to my after tax expenses, which is crazy to think about. So we want to make sure we provide a comfortable situation for people that they can afford. And that motto, just because you can doesn't mean you should. Plays a role. So
that's definitely true.
Just because you can do this doesn't mean you should.
No, it's absolutely true. I mean, people come to me and say, "Hey, I've been pre-approved for a loan up to, I don't know, $500,000." My first question is, what amount are you comfortable with? Because just because the bank says you're pre-qualified for this amount doesn't mean you have to buy a house for that amount, right? So it just depends on their goals and what their comfort level is, because everyone's different, right?
Absolutely.
So yeah, a good question, or a good answer there. All right, so let's go over another question here. Let's see. This would be from Josh Hankey. He also asked about the tightening of lending standards. I was going to ask you a follow-up question with you're mentioning about the average credit score 720. People have reserves of, I think you said, what, 9 to 11 months?
9 to 14 months.
Nine,
yeah.
Okay. And have you seen that change or fluctuate over, let's say, since this pandemic begun last year? Has that, how those numbers changed over time, over, let's just say, over the course of about a year or so?
Sure. So
and this is what you're seeing on your side, because you're obviously originating. I mean, how many loans do you guys do per month?
About 40 to 50.
40 loans per month. So you guys are doing a lot of loans per month. And so, yeah, I guess what are you seeing over the course of the year?
Sure. So we've seen some industries do very well and some industries do very badly, right? So there are a lot of people still have forbearance out there with loans. A lot of people still have student loans that are in forbearance also, right? You can have home loan debt, car loan debt, student loan debt, credit card debt, all in forbearance. So we're seeing these different categories, and I feel very badly for certain industries like retail, restaurants. A lot of community-based small businesses are still being affected by COVID.
Sure.
And I hope that can turn around and that they can survive and be okay. But I would say that from a credit perspective, the people that are still qualified probably before the pandemic, and they probably qualify the same way now.
Yeah.
So
it goes to show how some people, it's been this like K-shaped recovery, right? Where some people have been adversely affected by this pandemic. Others are doing exactly the same before, and others are, far off better than they were before March of 2020, right?
Absolutely.
So the question that you said about the forbearance, I think would be a good segue to ask you this. So I know there's like 1.8 million approximately people in forbearance right now. Represents, I believe, around like 3% of all U.S. mortgages, something like that. So once someone's in forbearance and they're going to be exiting, are they able to refinance their mortgage right away? Are they able to sell their house and buy a new property? What are you seeing on your end with their ability to do that?
Great question. What it comes down to, honestly, is going back to the company that you did the loan with to understand the goals or the solutions available with that specific investor. There are different ways people can get mortgages that they may not even be aware of. Sometimes they're owned by the government. Sometimes they're owned by private institutions. Sometimes they're owned by a portfolio like a credit union balance sheet.
Yeah.
So my first thing to do is I'm happy to help guide people through this process, but to go to your current lender first and ask them what opportunities they are to help with forbearance.
Yeah.
Once they've gotten those things worked out and they understand their goals, there are solutions that are available to refinance or to possibly buy a home once the forbearance period is over and someone's shown the ability to make those payments again.
I see. Okay. So when someone exits forbearance, there's a waiting period to make sure that they're still going to be on track to pay their housing payment, what it was before they entered into forbearance. Is that right?
Absolutely.
Got it. Okay. And so how long is that? I'm sure it probably varies by the lender, but approximately how long is that?
Anywhere as soon as 3 months to 9 months is kind of the range, and each product and company are specific to their own things.
Yeah.
Credit is also affected differently.
So that was another question regarding that. Yeah, absolutely. Yeah. Based on my understanding, if a person, correct me if I'm wrong here, but if someone has entered into forbearance and they were already current on their mortgage, then they can be in forbearance for up to 18 months, depending on when they entered. And so when they exit, their credit score, based on my understanding, it has not been affected. Whereas if you are already late on your mortgage and then entered into forbearance, during the forbearance period, they're going to be still dinging you, saying you're late every single month. And of course, your credit's going to be affected. But who am I to say? Is that what you're actually seeing in your neck over?
Yes, well, I'm seeing this. Each creditor is treating these differently. Some large banks were treating them as a natural disaster and coding them as a FEMA natural disaster loan. That gave them more flexibility in how they coded that for credit scoring. Some of them treated it as a regular late. It's very similar to 2008 in regards to everyone could treat these loans differently on their own balance sheet. So
Is
it
that
could be
weird? Why is that?
wildly.
Why is there not like a standard saying, hey, like if someone's in forbearance, I mean, I based on what I read, based on the CARES Act and all the stuff that came out after the CARES Act, it was they have to mark them as current each since every month. Then all the stuff came out with some yada yada bank, X, Y, and Z bank saying that they actually marked the file on the credit report that the person's in forbearance, and that dropped their credit score like just like that, right? So yeah, continue that. It's
Yeah,
a very
it's just
interesting topic.
it's very hard. Credit is in a black box. If we all knew how to trick credit, everyone would have 800 plus scores, right?
Yeah.
So the credit agencies have done a good job of protecting the things around that, right? Because we want to get a valid credit behavior for a consumer before they get into the largest financial decision in life, right?
Yeah.
So there's that trend that happens. But yes, it is unfortunate that even some borrowers got the bad advice of going back to their bank customer service people and, hey, don't make a payment or make a payment or whatever the solutions were. A lot of times, unfortunately, those guidelines changed from the government or from the credit agencies or from their own banks. And so decisions you made yesterday may have a positive or negative effect that you may not be aware of today. So
Yeah.
again, working directly with your current lender for any type of modification or workout is what you have to do. Any new purchase or new refinance, you can work with a mortgage broker or anyone else that you trust just to make sure that you have solutions available.
Got it. Okay. So someone's thinking about exiting forbearance, definitely should reach out to their loan servicer, which is the company you pay your mortgage to
Yep.
find out options about how to pay back all your missed payments. Everyone who follows my channel, I always say that there's no requirement to do a one-time lump sum payment if you have a federally backed mortgage, right? Most of the people we're seeing right now are doing a loan deferral, where you just add in all your missed payments to the back end of the loan. Your payment remains the same. It just increases the term of your loan. That's the vast majority of what we're seeing. All right. So thanks for that, Jim. Here's some more questions here from Josh again. Have you noticed any change in the typical borrower from pre-pandemic until now? I think we kind of talked about that a
We
little
talked about
bit.
that, yeah, pretty much. Not
Yeah.
really. People, unfortunately, the cost to purchase has gone higher, right? So the affordability shifts lower when the housing values continue to go higher, right? The trade-off is you hope that rates go lower to offset that increase in affordability, right? So when
Mm-hmm.
rates go lower, that's a good thing if the values stay the same for buying or selling a home.
Yeah, absolutely. I shared that maybe about a week or so ago. The National Association of Realtors released their home affordability index they do every month. And the index is down like, you know, far before, I guess it's like the lowest it's been in a year, I believe. And that's because home prices have shot up so much. And that's due to low inventory, of course, low interest rates, right?
Yep, absolutely. And I'm just hopeful that people that are like in their retirement years can actually live in a property that actually meets their needs. I see a lot of people kind of being trapped in larger, bigger homes because they don't want to move into
Mm-hmm.
a condo or something like that, right? So
Mm-hmm.
luckily, some of these propositions that have been approved in California allow people more flexibility with being able to move and pick up their tax basis. But again, there's a big migration out of California into other states like Texas, Arizona, Nevada,
Idaho.
Idaho,
Yeah.
right? So we're seeing people leave, and we're seeing companies also change the way that they bring back people with COVID happening or ending or
Mm-hmm.
continuing, how they bring back people into the work environment. Is it mandatory to come back physically to work? Is it okay to work remotely? Is it a hybrid thing? Can I fly in for 2 days a week from Colorado to the Bay Area and fly back home? It's going to be interesting to see how these long-term changes
Mm-hmm.
come from this pandemic. So
Yeah, absolutely. I'm personally seeing a lot of people in the Sacramento area who are moving here because of affordability, and then they still have a job in the Bay Area, for example. They're working remotely, maybe 100% of the time, or maybe some sort of hybrid approach, which, in my opinion, we'll probably see more of these hybrid approaches that probably should have been in place like years ago. But this pandemic really pushed the companies really to figure that all out. And so, yeah, but I agree. It's gonna be interesting to see what happens because more companies are asking their employees to come back, at least for part-time reasons. And if someone moved out of state or really far away from their office, then what are they going to do? probably I would negotiate with my boss if I was those people. That's basically what I would do. Well, Jim, this has been really awesome. I think I've learned a lot. I hope a lot of the viewers have as well. Anything else you want to add? And I definitely want also to mention too, how do people reach out to you in case they have any questions for you?
Absolutely. Thank you again for having me on your show. And
Absolutely.
I'm so excited to see this information you're giving people. It's better than anyone else I know providing value like this. So
Thanks,
you
buddy.
for doing. I know
Thanks, Jimmy.
it's not 15 minutes of time. It's hours and hours of your homework and really making an impact. Thank you.
Thanks, buddy. Appreciate that.
No problem. So I can be reached anytime at jim@allcalfinancial.com. My best phone number is 925-285-4898. And my website, it's pretty easy. It's www.meetjimblack.com. So again, meetjimblack.com. So happy to be on the show. And again, if I can help anyone that needs another perspective or another opinion, I'm happy to be there as a resource. My team and I are honored to be part of this transaction and process with you and journey ahead. And Jason, thanks again. And I appreciate you having me on.
Absolutely. It was really fun, Jim. I would love to do this again. And I would definitely say that, I can definitely vouch for you. I've refied with you. You helped me with a home purchase. And so I definitely value your wealth that you bring to the mortgage industry and then really helping out people. So thank you so much for joining us for today. And anyone out there who got any value out of this video whatsoever, then please hit the like button and please consider subscribing to my channel and reaching out to Jim Black in case you have any real estate related questions. So with that said, I'll see you in the next video.